All right, Mitch Rochelle is joining us. Dave Maney joining us. Neither is pregnant, but they know of this world. So let me ask you, Mitch, you know, we're talking about the inverted yield curve. And what I notice is something a little wacky. If the Federal Reserve raises rates by the 75 basis points it's expected to, overnight money, federal funds money, is going to be about 2.5%, right? And a 10-year is at a little north of 2.75%. That's weird, isn't it? I mean, money committed for a day yields you about as much as committing it for 10 years. What do you make of that?
It sort of makes no sense when you think about it. There should be a curve to interest rates over time. It's just completely logical. What the market is signaling is we think that the economy is going to slow, and if you're buying long-term debt, they're chasing that because they're fearful that there's a slowdown ahead. The thing that really nobody focuses on, so I'll bring it to the attention of your viewers and listeners, is this is really rough on the lending world because they sort of bank on short-term rates, the way they borrow, being lower than long-term rates, which is the way they lend. And it's really bad for lenders. And one of the things you need to help the economy is the availability of credit, because that's what, that's the lubricant that makes commerce work. So I think it's worth underscoring the fact that we have an environment that could be self-fulfilling prophecy if lenders don't want to lend in this environment, which is going to stymie growth.
You know, when you look at it, Dave, Fed funds, this overnight lending rate, I can just see viewers now clicking off their TV. But if you think about it, it should mirror whatever the inflation rate is, or close to it. Now, that's unrealistic in an environment where inflation's north of 9%. But the sentiment is that the more the Fed hikes, the more likely that inflation rate goes down, and they don't have to get to that level. Where do you see this going? I only mentioned it because Bank of America said today, by next year at this time, the Fed will be cutting rates. Things will have slowed so much. Do you buy that?
Yeah, it could be. I mean, look, there's been Nobel Prizes in economics won and lost on signaling, information signals and how markets and buyers and consumers and producers react to signals as opposed to, specific prices, which are also a form of signal. And so I think that, they may have accomplished huge parts of their mission already. And let's remember the other thing, Neil, which we've talked about before. This was a sort of a synthetic inflation created by idiotic, let's shut down the economy policies. They could go away more quickly than a traditional kind of grinding multi-year build inflation. Not saying that I know that, but there's some strange signals in the environment right now that suggest that that's a possibility. And if I were a betting man, I'd bet that it goes away faster than we guessed it would.
Well, if that were the case, and we might see signs with gasoline prices that have been coming down, some of the more worrisome commodities uptick in prices, Mitch, also coming down, not across the board. And the resilience of the consumer through this, again, not across the board, but American Express makes note of it. On the other end here, McDonald's and Chipotle making note of it, that people are absorbing these higher costs and still buying stuff. So is it your sense that we dodge a recession, that we have something that certainly speaks of a slowdown, but it won't be around very long? What do you think?
I think there'll be a slowdown. We can debate forever the definition of recession, right. But I do think we're going to have a slowdown, and I do think it's going to be relatively short-lived, but it's going to take really smart fiscal policy to get us out of it. And this administration really hasn't been smart on fiscal policy because we still have a broken supply chain. And the only way to ramp up the economy to pull us out of this is to fix the supply side of the economy. And I worry that higher interest rates and the inverted yield curve, as I said earlier, aren't exactly factors to help the supply side of the economy.
That seems to me, Dave, that we could be in for a stretch here. What do you think?
We could, but again, I want to go to, that's an interesting comment that Mitch just made about fixing the supply chain. But what that means is, I'm not so sure that people have to go build new factories. They kind of need the world to get, broken supply chain means my suppliers are not capable of giving me what I want. And that's happening in all kinds of sectors. But that means getting people back to work, which, I don't know how interest sensitive it is when my line was shut down or I'm only running two shifts instead of 3 because the economy was screwed up or I couldn't get the labor. My only point is there may be more kind of Stay Puft Marshmallow Man, like it's overinflated that goes away faster when you fix some of these human and labor problems that I think don't necessarily take gigantic investments. So it's possible.
All right, we'll watch. Gentlemen, thank you very, very much.